Hello, everyone. I hope you're having a wonderful start to the holiday season. A quick little itinerary for what we'll go over in this clients only commentary. We'll discuss the defensive portfolio performance, cash yields, and the cash accounts, and then round it out by discussing the new private equity fund of funds offering. So, without further ado, let's talk the defensive portfolio. The defensive portfolio outperformed the S&P by 37 basis points, which is a positive development. As a reminder, the defensive portfolio is invested in 75% high yield fixed income and 25% long-term treasury securities. Of course, returns and allocations may differ depending on investment timing, amount, fee levels, and other miscellaneous factors. So returns based on your individual investment account, which you should see on your quarterly investment statement that I sent out last week, may reflect something different. To reiterate, our strategy anticipates that the S&P 500 will not outperform the defensive portfolio by more than 25% before experiencing a 20% correction. Once that occurs, we'll then buy into equities at a better basis to generate superior long-term performance versus remaining 100% in equities 100% of the time. So any outperformance from our defensive portfolio essentially extends our margin of safety for when that stock market drawdown will occur, which is around 5 years at current levels, but expected to occur much sooner than that. For those of you who have the appropriate risk tolerance, we will leverage the equity exposure to generate even higher long-term returns, albeit with increased volatility. It's also very encouraging to see the defensive portfolio rally when equity markets fell. This points to the original thesis that the portfolio should appreciate when stock markets fall due to investors rushing into high-quality fixed income assets. This performance stems from our 25% long duration treasury holdings, which are seen as safe havens by investors, and you can see this dynamic on the graph shown as denoted by the purple and orange arrows, which represent the defensive portfolio and S&P 500 respectively. You'll note that the purple arrow points up when the orange arrow goes down. Markets behaving in this predictable fashion points to the confirmation of the original thesis and should allow us to outperform even more when stock markets fall. In addition, it makes it behaviorally easier to get more aggressive when stock markets fall. Now moving on to cash yields. So the Federal Reserve cut rates by 0.5% in September, which will impact the yield you generate from your cash holdings, as I hold a lot of short-term securities that are closely tied to the federal funds rate. Despite the rate cut, the money market fund is still slated to deliver around 5% annual return, which is far more than what you can get in your bank savings and checking account. This will always be the case and still points to keeping your cash invested in the money market fund. Only when the federal funds rate is near 0% does it make sense to keep all of your money in your checking account, given the 2 to 3 days it takes to get your money from the money market account into your checking account. So given the generous yields, there's no need to move excess cash into markets at this point. Most of you are utilizing the complementary cash account for emergency savings, so investing that money is really a non-starter to begin with. But for all of those who have excess money, excess funds over and above your emergency funds needs, it still doesn't make sense. It will only really make sense when capital markets fall in price or rates get cut considerably. So for now, continue to enjoy the attractive 5%-ish yields. For those of you for which it may be appropriate, when markets fall, we'll begin discussing possibly moving that money over. I've spoken about this a lot with a few of you, but I'm excited to announce a new product offering for high net worth clients. It's a private equity fund of funds. I'll send a presentation out to all of you in conjunction with this commentary, but basically a private equity fund of funds is a private mutual fund of private equity managers. It's confusing, I know, so hopefully this little illustration helps out. We've partnered with RCP Advisors out of Chicago to provide this private offering. This is an investment firm that I have significant working experience with when I was working with the family office and who I think highly of. The upside of a private equity fund of funds is that we expect to generate around a 1 to 3% excess performance over public market investments like the S&P 500. However, this does come with the trade-off that the invested funds will be locked up for approximately 10 years. So unfortunately, we can't have our investment cake and eat it too. You also need at least $500,000 to commit to the fund, which implies at least a $2.5 million account to prudently diversify your portfolio. So while this opportunity may not suit everybody, I will be reaching out to qualified clients shortly to gauge interest. Now you may be asking yourself, Scott, is there a catch? Are you making more money from this? No, not at all. This offering is 100% included in your investment management fee. So EID Capital doesn't receive any extra fees from whether you invest in this offering or not. This is because I believe my competitive advantage over your typical wealth management shop is that I'm qualified to offer these products, whereas other shops are not. So that's all I have for you this quarter. The next presentation will be given in the new year. So I hope you all have a wonderful holiday season. And as always, if you have any questions or requests for me, please, please, please do not hesitate to reach out. All the best, and I'll see you later. Bye.